disinflation. I'm not calling for deflation. Deflation is when prices go down. I can't rule that out, but I don't see that. That's not my, intermediate term forecast. But disinflation is. I see these numbers going down from, 6%, 7% annualized, which is what the government's showing, getting down to the 4% level and eventually down to the 2% level, which is where it was from 2009 to 2019 during that 10-year expansion during Obama and Trump. And there wasn't much difference between Obama and Trump in terms of growth. I know, Trump claimed the greatest economy ever. Well, that's fine. That's a talking point. But the fact, if you look at the numbers, the Obama and Trump economies were, kind of the same, right around 2.2% growth. Inflation was between 1.6 and 2. Rarely, if ever, touched the Fed's target of 2%. That's where it's heading again. So not deflation, but disinflation. This inflation bubble is going to go away.
So, Jim, let me ask this question because this is I want to help solve some of your books, The Great New Depression. And it's a fabulous book.
Thank you.
And I want people to be inspired to read it so they're prepared, because you and I are old enough to be either Paul Revere's or Chicken Littles, if you know what I mean.
Yeah.
Where for all these years we've been saying the British are coming or the sky is falling, either way. And I first came across the dollar going off the gold standard in 1971 while flying in Vietnam. And I said, What the heck what does that mean? And I knew it was going to get bad, which is why I became a gold and silver bug. But I didn't think it was going to get this bad. And so that's why your book, The New Great Depression. Would you mind defining that Great New Depression for us? Because that's disinflation.
Sure.
Can I just interrupt for 1 second? Can you just give your definition of disinflation?
Yeah. Disinflation is inflation at a lower rate. So now you still have inflation, but if it goes from 8% to 6% to 4% to 2%, which is what I'm saying, you still have inflation, perhaps inflation of 2%. And that's not trivial. Look at the value of the dollar and a half in 35 years. So it's, by the time you're, most people are young adults at the time the kids are in college, it's about 35 years. So, or less. So that's real. But going from 8% to 2% is a big deal for a couple of reasons. Number one, it means that 8% number is not sustained. If it is, if I'm wrong, I don't think I'm wrong. I wouldn't be giving this analysis. But if I'm wrong and inflation goes 8%, then it's probably on its way to 15. So that's a completely different scenario. That's not the scenario I see. But you have to watch.
That what you define as hyper or super inflation then?
Well, you're getting close to hyperinflation at that point. And again, Kim, just to be clear, I do the analysis. I have a view. I look hard at the data. I have models. So I exercise a lot of care on this, but I don't just ignore the alternatives. Sometimes you're wrong and you have to pivot. So yeah, we should all be watching for signs of inflation. I don't see them. I see disinflation, which means you still have inflation, but it's at a much lower rate. But there's a world of difference between, let's say, 1.8% inflation and 6.8% inflation. Those are completely different worlds, because one is much more manageable, but it also changes expectations. And expectations are the key. The Fed doesn't control inflation. Everyone's like, oh, they print money, you get inflation. That is not true. It's not true in prices. It might be true in asset prices. It might be true in stocks and bonds and real estate, but that's not the consumer price index. That's not what the Fed looks at. That's not what most economists or many economists mean when they say inflation. They're asset bubbles. Money printing can lead to asset bubbles, but it does not lead to price inflation unless velocity picks up. Velocity is a psychological phenomenon. So if you change the expectations and change the change the psychology and change the velocity, you will get inflation. But I don't see any of those things changing. What I see is this runs out of steam and we get back down to below 2%.
So my concern is, why did you write The New Great Depression?
Well, first of all, thanks, Robert. First of all, it has to do with the definition of a depression. And most people don't have a good definition of depression, and economists don't even use what I call the D word. They don't like it because let's compare it to recession, the R word, okay? So recession is well defined. It's two or more, or at least 2 consecutive quarters of declining GDP. There are a couple other bells and whistles about employment, and there's a referee of the National Bureau of Economic Research, a private, econ think tank in Cambridge, Massachusetts. They call the balls and strikes. They tell you when a recession begins and when it ends, when the expansion ends, et cetera. But two or more consecutive quarters of declining GDP, that's the classic definition of a recession. So people go, depression sounds worse than recession. And if recession is 2 quarters of declining GDP, a depression must be 10 quarters of declining GDP. It must be way worse. And that's not the definition of a depression. First of all, 10 quarters of declining GDP has never happened. If it did, we'd all be in trouble. But maybe during the Great Depression to some extent, but not otherwise. But that's not the definition of a depression. Depression means depressed growth, meaning you can have growth in a depression, but the growth is depressed relative to trend, relative to potential. So in other words, if your economy, if the long-term trend of recovery growth in a recovery is 3.5%, which it is, and you're growing at 2%, which we were for 10 years, that's depressed growth. You're creating a wedge. So here's the 3% trend line, and here's the 2% actual growth. Well, in between those two lines, that's depressed growth. That's lost output. You could have been here, but you're actually here. And because it's a wedge, guess what? Over time, it gets bigger. I would say we've been in a depression since 2007. That the entire so-called recovery from 2009 to 2019, it was a 10-year recovery, the longest recovery in U.S. history, but it was also the weakest recovery in 10-year history. The average annual growth for that 10-year period was 2.2%. But for all post-1980 recoveries, average growth was 3.2%. And if you go back to post-World War II recoveries, it's closer to 4%. So if you have an economy that can grow 3-4% and you're growing at about 2%, that 1% is, 1%, what's the big deal? Sorry, 1% of 20 trillion compounded for 10 years is a big number. You're talking about trillions of dollars of lost wealth, lost output, and from the government's perspective, lost taxes. So that is the definition of a depression. John Maynard Keynes defined it that way. It was good enough for Keynes. It's good enough for me. So I would say we've been in depression in 2007, but the new Great Depression is where we are now. It's by the way, that book has 3 chapters on economics, the new Great Depression, but also has 3 chapters on the pandemic. So it's kind of a mixture of the impact of the pandemic and then the effect it had on the economy.
Fantastic book.
You can't disentangle the two. I had a debate with my editors. Jim, we love you on economics, but you're not an epidemiologist. I said, well, I know I'm not. I'll admit to that, but you can't, writing about the economy and not mentioning the pandemic, it's like talking about property damage in New Orleans in 2005 and not mentioning Hurricane Katrina. I mean, you have to mention the pandemic, and I did. And I included a chapter on the mental health aspects, by the way. There's a lot in that book that was way ahead of today's conventional wisdom. I said I concluded that the virus came from a laboratory in Wuhan, that today that's the consensus. I said that lockdowns don't work. Today, that's the consensus. Masks don't work. Today, that's the consensus. But all this stuff was heretical, a year ago when the book came out, but it's all in there. But as it relates to the economy, it's just one more reason. Now, having said all that, yeah, COVID has not gone away. The pandemic's still here. It's still depressing growth.